If you in a SPAC game, you know what I'm talking about. We sick of IPOs day one locking us out. My man Randy first told me DraftKings would go public. It's merging with a SPAC and the market go up.
TechAviv is a global founders club of Israeli founders. We've been around since 2007. It's a non-profit founders club. The whole spirit of the group is a framework to enable Israeli founders to help each other build better companies. And pre-corona, we would meet offline in major branches in Israel, Silicon Valley, New York, and Boston. But we have members in 16 cities around the world. And we would typically do these types of events offline. And I have to tell you, I miss it badly. I have Zoom fatigue as much as anybody else on this call. But we're making the best of it, and we're seeing the light at the end of the tunnel, I believe. Most of the Israelis on the call probably have 2 shots already, myself included. Howard, really? What'd you get, like old man exception?
Phoenix has Phoenix like the desert. All the desert places have it. We did volunteer work, my family and I, and we got the shots.
There you go. Okay. So we're a nonprofit organization. Everything we do is free. Our members have a member app where they can find each other and ask for help. The whole spirit is to help each other out. And in terms of helping us out and doing these and all the offline events, we have one big global sponsor, which is Jefferies, the bank, which I don't think we have anybody on the call today from Jefferies, but I wish we did, because they are one of the top 3 banks right now doing SPACs. They, by the way, shared this really good research report that they've done. I'm going to put this in the chat. For the sponsorship, I'm going to send everybody the document that they wrote with every possible stat and data point you could imagine for SPACs. For this call today, we're going to assume that everybody in the call has a basic knowledge of what a SPAC is. We want to focus on pros and cons as it relates to founders. On the call today, we currently have 88 TechAviv Founder Club members and some guests that we invited. And we want to really kind of give them as much candid, unconference, Israeli feedback on the process of deciding to go public via SPAC versus traditional IPO or direct listing. Let's start with intros. Omer, please say a few words about yourself and your company.
Yeah, sure. So I'm Omer Keliaf, like all of you. I'm kidding. Founder and CEO of Innoviz. Innoviz is developing technologies for autonomous cars. Specifically, we develop a sensor called the LiDAR, a very small sensor that gives you 3D sensing. And we have several programs, including BMW, to go public in the coming years. And now we're going public. We just announced our voting on the 31st of March, which is exciting.
Congrats. Assaf.
Sure. Assaf, CEO and co-founder of Hippo Insurance. In short, our vision is protecting the joy of home ownership. We want to help people take care of their home and live more carefully and secure in their own environment. That's it.
And okay, say a word about your SPAC. It's a pretty special one.
Oh, no, we can, I thought to leave it later.
Okay, fair enough. We'll leave it to later. Ronen.
Yep. So I'm Ronen, product guy by nature. Co-founded eToro.com in 2007, growing the company to over 20 million registered users on the platform that we recently announced. We've basically built a social network of top of traditional and somewhat non-traditional brokerage services, where everybody in the network can see, follow, and automatically copy the performance of all the other investors on the network. And up until recently, I ran product and engineering, and now running mostly strategic initiatives.
Oren. You're on mute, Oren.
Yeah. Oren Zeev, I'm a one-man VC. And when I say one man, it's truly one person. I don't have any staff or physical office or personal assistant or anything. And as far as I know, and yet I manage over $1 billion, and I invest about $250, $300 a year. As far as I know, there's nothing that comes close in the world. There are some 1% VCs, but they're typically like 1/10 of the size. So this is, yeah. So it's called Zeev Ventures.
And last but not least, SPAC Lindzon. Howard.
Hello, everybody. I'm Howard Lindzon. I started a few companies, currently stock twits, claim to fame, I guess, but not day-to-day involved. And seed investor, early investor in eToro, maybe 2010, and Robinhood. So focus on financial services. We're a 3-person team, couple $100 million under management. We write $1 million checks. Finally got to Oren's leading a deal, Marble, that we're finally investors together in.
A great one, by the way.
He's a great founder in San Diego. So worlds colliding. I luckily don't know everybody here, but luckily Yaron was the first person I met on my returns to Israel back in 2010 when I finally got coming back to Israel. First kind of person I met, invested in his company. Then I met Ronen. I met Yoni on stage, who was presenting eToro, and that's kind of now I go back to Israel every year except the last year. So miss Israel and excited to be on the panel.
What stage was that where you met Yoni?
See, I think they were seed running. It was still kind of a seed deal. It was like a 30 million valuation.
No. I mean, where did you meet them? How did you meet Yoni? How does an American from San Diego meet an Israeli startup on a trip to Israel?
Ken Weiss was inviting me. He was a Greylock Israel at the time. And he kept saying, you could come to Israel and invest money. He thought I had money. I go, I have no money to invest in Israel. I'll throw some trees your way. But, and so I come to Israel, and the first pitch was Yoni. And I looked at my wife, who's actually listening over my shoulder. I go, we're writing a check into that company. And so we did. And then we met you and wrote a check into Billgard.
So, and we're all grateful for it, by the way, Howard. You've been a great ambassador for Israeli tech.
We're investors in TechAviv as well.
Yep. So now the world has changed since you made that first investment in eToro. As we speak, there are currently 55 Israeli-founded unicorns that are roaming the planet. We actually have them listed on TechAviv. If you go to techaviv.com/unicorns, you can see them. And as you can imagine, with this wave of SPACs coming to the markets, they've been bombarded. And so the 3 founders that we have on our panel today have all probably, I'm assuming, fielded lots of different inbound requests, not only from bankers who wanted to take them public, companies who wanted to buy them, but definitely a few SPACs, I'm sure, that wanted to take them public. And what I'd like to start with is diving into your experience, that one bright morning where you decide, you know what, I'm actually going to go down the path and evaluate taking my company public via SPAC versus traditional IPO or direct listing or staying private. How does one make that decision? There are, by the way, a couple of unicorns in our attendee list here who are listening, who I'm sure are curious about what they should be doing and thinking as they're getting approached. In TechAviv, we have 48 unicorns. We have over 200 companies that are valued over $100 million. About 50 of them are valued over 500 million. A lot of them are getting this conversation in their inbox. Omer, how did you decide that it was the right time for you to take your company public, and specifically via SPAC? Can you walk us through that?
Yeah, I mean, it was somewhere in the middle of the Corona, where everybody was kind of trying to understand, going forward, what is the best plan forward. And we started to notice that there is a pickup of interest on the SPAC space in the US. I mean, we've noticed that many companies in the automotive space are going on the SPAC process. For us, it was an opportunity. We didn't know how to expect if this would continue or not. But once you realize the opportunity, it's very clear that it's something that you should achieve. I mean, in the automotive space, there is a long desert that you need to cross. As you might know, the sales cycles are a few years, specifically with a company that is hardware oriented, and there is a lot of investment needs to be done. This is something which is very critical. So add to it that we started to notice that some of our competitors started to go public. You also realize that it becomes a competitive advantage. You can't be in a position where your competitors are now raising hundreds of millions of dollars, and you, which have the best company, obviously, is left behind. So for us, it became not only a nice to have, I would say an opportunity, just a mandatory. It became something that we must achieve, and we focused our attention to make it happen.
And specifically a SPAC versus the option to try to do a traditional IPO or direct listing?
Yeah, so I think it's clear for we're a younger company. Okay, so we were founded in 2016, and we are mostly I would say that we have an order book rather than revenues, right? Because we won the BMW program. It gives us a very credible and I would say a very good outlook of revenues in the coming years, but it's less relevant for a company to go IPO because most of our revenues are in the future. We have the benefit that we have won those programs, so we can rely on them when we talk with investors, and that's actually a good fit for a SPAC versus an IPO, which you can actually rely on your future booking. So that also was a clear path.
Okay, so here it was the only option pretty much to go public. Assaf, what about you? So you've been around a little bit longer. You've had lots of options in front of you. How walk us through your thinking as this evolved?
So I think the first question you need to ask yourself, and people has a tendency to forget, is the company ready to be a public company? We've been working on it basically for a year to be ready to be a public company. Can we forecast on a quarterly manner? Can we hit the numbers on a quarterly manner? Can we beat and raise for the next 6 or 8 quarters? Do we have the right GC, the compliance method? We needed to hire a CISO all of a sudden because your fintech company is going to be potentially attacked. There's just a lot of steps that we made a crazy list to make sure that we're going to be ready to be public. We were actually on a track to be kind of like to do a regular IPO. So the first thing was, are we ready as a company to be public? The second thing, once we tick mark that, because you also want audited financial reports for the last several years as a public company. There's a lot of stuff that you need to prep. I think in the SPAC, many times people rush it and then they realize they're public and whoa, where did this came from? I think it's really important to do all of the preliminary work before. So first, tick marking that we're ready to be public. Then, do we want to be public? There's still an abundance of capital in the private markets. When we were looking at this transaction, we had $500 million in the bank. We did an interesting deal with Mitsui Sumitomo, which bought us an extra $350 million. We had $510 million in the bank when we signed the transaction. So it wasn't that we needed the capital in order to do that. So we asked ourselves, is it the right thing? Is it the right timing for the company? We realized we're in a game of insurance. A game of insurance has to do with trust. You gain a lot of trust by being a public company, and it's important. It's important for our partners, for customers, for banks and all kind of other partners that we work with. So we tick mark that side that we're ready to be public. We basically did a dual track. So I'm sure like half of the companies that are listening, you've been indebted. Like there's just a bunch of SPACs that are calling us. This was around June. So the perception of a SPAC was still that it's the bottom feeder of Wall Street. And when they called us, like, it's just irrelevant. What do you want from our life? Kind of that discussion. Over time, 2 things basically happened for us as a SPAC to look at SPACs. The first one, we became jaded with Wall Street. Every IPO that came popped by like 50%, 70%, 100%. And then we said, fine, if price exploration is all over the place, then there is a problem with the process. And basically the customer is not you as a company, but it's actually the asset manager and Fidelities of the world who's making money out of that. Because I had extra dilution for money that I didn't raise. So so that was one. There was a sub kind of project that we did on the side. We actually analyzed 5, 6 IPOs of companies that we thought are somewhat interesting in the field, Root and Lemonade and stuff like that. And we looked at the Bloomberg and say, who got what allocation at the day of of the IPO, who had what basically shares after a week, after a month, after 3 months. And what you're seeing is that the biggest day traders are actually Fidelity's and Wellington and eToro. They're the one who's actually ditching the shares. So all of this entire perception that we can, we can educate and build a cap table and bring the right investors that are long only, which is, didn't pass our sniff test. So now we've been jaded with Wall Street on some kind of components. And then on the other stuff, some of the people that we trust the most, that I think are the best investors in the world, started to have their own SPAC. So I mean, like, these are people on our cap table, Rebit, Dragonir, people that I know the guys. Like, listen, I know how much due diligence they've done on us and in the level. So we called Mark Stad and we called Mickey Malka and we call all of these guys to understand what their thought, what are they doing it, and then you realize there's actually, it's not a SPAC versus no SPAC. At least on our side, it's specific SPACs that we were a good fit for us versus other SPACs. I don't care about the 500 SPACs. I care about the 5 SPACs that we thought are the right fit for us. And so, okay, so we said, okay, fine, interesting SPAC. And then, sorry if I'm because we spent a month on this thing to basically educate ourselves. And then we came with another format on the SPAC, which was the right thing for us. First one was price. So there were 3 components. Price, by the way, not maximizing price. When we talked to the bankers, we had higher valuation to do an IPO than what we actually took from our SPAC sponsor. Because the SPAC sponsor that we were talking with, they believe that they're building a franchise and they don't want to come up with the highest valuation, and it's not about the transaction and done. So price was actually very different. So, but we had a certain threshold, which in our case was $5 billion. We add higher valuations, LOIs from other SPACs, and even our SPAC came back with a higher valuation and said, fine, awesome. I know that you came with whatever, 5.5. We think the right price is 5. We want to set it up for success and then up in the market and stuff like that. So price was one. Second thing was certainty. So we wanted to make sure, because we're signing now on something which gives us a price in 3 months, that this is going to be the price, but at the same time, the validity of the transaction to happen is close to 100%. So you put all kind of terms of minimum closing requirement. We wanted smaller SPAC and higher pipe because the pipe is committed and the SPAC is not necessarily committed. Even if all of the SPAC redeem, we're still going to go public. I had very honest discussion with all of the sponsors that, because there's a misalignment, but if the market goes up by 2x, it's still going to be the same price for the SPAC. But what if the market goes down 50%? I don't want to negotiate. We shook hands on a certain price. That's the price. So we cared about that. We wanted people that are going to have a reputational risk of leaving. It's not a baseball player who it's a one-off. If it doesn't work, who cares? We wanted people that have reputation in the market. We wanted something that we call industrial strength. We wanted people that have several SPACs. And if they're effing it up with us on this SPAC, they're going to lose their franchise because Wall Street is going to come and attack them that they pulled out of a deal and stuff like that. So this is under certainty. And the last component that we put was alignment. And alignment has to do, also partially with smaller component of warrant. We have a 1 to 5, and all of the warrants coverages we took were either no warrants or low warrants. We have a lockup of 2 years, and they have a lockup for 2 years. Their pricing is from 10 to 20. They're only making the full promote if the stock doubles. There was just a bunch of stuff on alignment, and I think we were very fortunate to have,
Let me. You skipped over some very important, or you said some very important things very quickly. First of all, negotiation on the valuation of the company, as opposed to kind of like that rigorous roadshow process with banks. How does that work with a SPAC sponsor group? They approach you. How do they go about valuing your company? How's that negotiation done?
Again, there are several kinds of SPACs. The SPACs that we talked to had the full infrastructure behind them to do the full due diligence.
Okay.
Hence, they run, you talk to Dragonir, you talk to Rebit, this is like a late stage private equity kind of deal. They're doing everything. You talk to some other people, they're just trusting whatever Wall Street is handing over or whatever you negotiate. By the way, as a side note, there's going to be a bunch of lawsuits against SPACs in the future exactly because of this point. Once there's going to be a blow up at one point, and there's going to be some issues, and there's going to be lawsuit after lawsuit about the amount of due diligence and fiduciary duty that they failed to actually deliver on. So we wanted people that do everything up front, and there was a lot of due diligence on that part.
There's a very important point there, which is that there's no doubt that there's going to be some disastrous SPACs in terms of companies going public that shouldn't be going public, and valuations that were led by hype versus proper due diligence. And that's something that is going to be very hard for a lot of founders to figure out if they're not approached by lots of different SPACs like you were. The other thing that you mentioned was 2-year lockup. Is that standard? Ronen, Omer, are you guys seeing that? Is that something that is standard? And also the fact that the sponsor group will not get their promotes. For those of you who don't understand what the promote is, maybe one of you want to explain what a promote is for a sponsor group. It's a big driver for all this activity. You guys want to comment on that? Is that industry standard? Is that what we expect? You need to 2x valuation to get your promote, 2 months lockup, a 2-year lockup.
Well, I don't know if it's a standard or not. I would say it's not in our case. Our lockup is 6 months. I have no idea if that's standard or the other one.
No, there is no standard. It's a Wild West. It's by the way, there will probably be a standard as time goes by, but right now it's all over the place. And Assaf's example is on the extremes, definitely the most extreme I've heard of.
Okay.
But there is a trend. But there is a trend in that direction, by the way.
I think 6 months is probably the minimum.
Yeah.
I have not seen anything below 6 months. And probably
actually I saw. I mean, I've been tracking some SPACs deals, and I've seen situations where the management or the founders had the opportunity to be in a non-lockup for part of their shares. There was, I mean, I've seen some.
It's difficult because you need to sign you need to register the shares as an S1 in order to sell them before. It usually takes 3 to 4 months to finish the S1 registration, which brings you back to the S4 registration and lockup of 6 months anyway. I think it's one of the benefits of a SPAC, which we're going to talk on the Pro, is the customization of the instrument. And because of that, you can align. There's a lot of, our sponsor, which is, Reid Hoffman and Mark Pincus, had another SPAC with a company called Joby, and they're locked for 5 years. And every year there's going to be a tranche, and the price is up to 50. In Rebit's case, they're also getting the promote up to a price of 5x, which is 50. There's a lot of, and you can customize and you can structure it. That's the benefit of this instrument. It's not a one kind of mold fits it all. There are kind of nuances, depends on the company, depends on the attractiveness, depends on a lot of things.
Ronen, and by the way, so for those of you who are listening in, if you want to ask a question, ask it in the Q&A, please, not in the chat, and we'll try to get to some of them. You've got some great questions so far, and I'll try to get to them. But Ronen, maybe we can continue on this path of trying to understand a little bit more on how do I know if it's a Wild West and it's highly customizable, which has its benefits. We could also be potentially abused by a sponsor group that is taking advantage of our lack of knowledge. Did you work with someone who was on your side advising you? Maybe you can speak first of all about your SPAC. It's, I think, the largest in Israeli tech history. You want to speak to it?
Sure. So I'll start from the first question. I think traditionally, people tend to look at SPACs as sort of investment banking on steroids, and I think that's the wrong perception. I think, as Assaf said, there are, I don't know, by now 500 different sponsor groups. And just like every due diligence, it's not just one way. So if you have a good company which you believe in, you also do enough due diligence on investors that want to come in, not only in a SPAC stage, but also if you're raising seed, right? So I think it's no different. There may be more elaborate mechanics to it, but it's no different than getting 5 term sheets at a seed round and asking enough questions from colleagues of yours, other entrepreneurs, if these are good investors or bad investors, or what has been your experience with them. So I think the mechanics is only the secondary question. The first thing I would look at, I would look at it more synergetically as, trying to bring the right sponsor groups to create real partnerships and not just people who would cement the deal and walk away. For us, it was very important to get a group that has the right experience dealing with fintech companies in the US. We've been in touch with the Cohen Group for the past, I think it's 2 years now. So we've had a long standing relationship with them. They've been a couple of times to our offices. We've seen them numerous times. So it wasn't just, this very one-time relationship.
You have Betsy Cohen leading the SPAC, is that right?
Yeah.
For those of you who don't know Betsy Cohen, she is a 78-year-old Wonder Woman. She is like the queen of SPACs and one of the most knowledgeable, sharp people in the industry. This is like cream of the crop. How did you get in touch? How did they get in touch with you? How does that happen? How does Betsy Cohen contact you?
Interestingly enough, I don't remember who made the initial connection, but they came to the office here, I think somewhere in 2019. We've gotten to know them. And so, she's obviously a force of nature, very, very experienced in everything that has to do with the fintech world. And, we look highly on this group for their experience, but mostly really the synergies between what we can bring to the table and what they brought to the table. And I think, again, it's not always the case. I mean, sometimes it would be a deal by deal or something a bit more ad hoc in terms of the opportunity, but definitely the level of diligence that needs to go on both sides is very important. It is a very interesting vehicle to go public through, but there are lots of different mechanics, as well as, by the way, I think people tend to maybe misrepresent how complicated a traditional IPO is. And if somebody comes and in the first email, which we've also happened to us, just throws you a price, then it's not serious, right? And so you go through the same extensive due diligence, just like any other deal. You talk to, I don't know, a gazillion different investors. And so you really have to cement the deal, not just between you and the group, but between you and several dozens other big investors, I would say institutional investors.
Is there somebody to call if you're an Israeli founder and you get approached by a SPAC group? Is there somebody to call who's on our side who could give us feedback on the whole process and help? That's kind of an objective person.
So I'm happy to share my personal contact with any entrepreneur who has this dilemma. I think it's important, but I would definitely advise, if you're seriously thinking about it, don't do it without a bank, because that's how the world works. We might not always like it, but you have to go through an investment bank. In our case, it was both Goldman and Citi who did an excellent job. But there are, I would not underestimate the thousands of hours who go into this process with accountants, with lawyers, with bankers, with investors. It's not a seed round when you and your founder decide to do it together and sign a term sheet. It's a whole different ballgame, and you want to have it right, because both the responsibility and the liability are quite extensive when you're dealing with the public markets. And I always like to quote Spider-Man, with great powers come great responsibility.
So first of all, I appreciate you making that offer. I don't know if you did it formally or not, but it would be great as we have more, TechAviv members.
Ronen at eToro.com. Ping me, and but I'll give you a big disclaimer. Just a big disclaimer. I'm a product guy, so don't ask me if I can do your audited financial results of 20 whatever. Or for all kinds of fine print when it comes to the legal stuff.
Okay, but very important. And in the spirit of what we do here in TechAviv and helping each other out, I think as you guys, the three of you now have this very unique domain expertise now of the process of merging and being acquired by a SPAC. It's a type of knowledge that we want to be able to pass down, just like we pass down learnings for company building and IPO and so forth. So it's wonderful that you're offering that. What about, so Oren, you're an investor in Hippo. Assaf calls you one day and says, Reed and Mark Pincus want to take us public. What questions do you ask? How do you guide your founders on whether or not it's the right decision or the wrong decision? from the perspective of an investor in one of these companies?
First of all, in general, Assaf guides me, not the other way around. So, and literally in this case, he's the first company in my portfolio that took the SPAC route. So literally, I'm not kidding. He has been my guide. Every time I have a question, I call him because he's ahead of everyone else. Look, I think Assaf summarized it really well. At the end of the day, first you wanna, I don't want to repeat everything that is said, but just the gist is that first of all, you want to decide that you want to be public versus all the other alternatives of not going public or wait with going public. And if you do decide to go public, then you have a decision between the traditional IPO and the SPAC. And a third one, which is less popular still, but maybe more popular in the future, is direct listing. Each has its pros and cons. And some companies, one path makes more sense. Some companies only have, any company that can go traditional IPO, direct listing, could also go SPAC. The other direction, not so true. So some companies can only do SPAC, but the companies that have more than one option, it really depends. At the end of the day, they make a decision. In all the cases, use the bank, by the way. Whether you go, doesn't matter which path you take to going public, you're gonna use the bank. So
how do you in the case of Hippo, in the case of eToro, I'm assuming you had the option of going public via traditional IPO versus a SPAC. SPAC was the preferred route to go, I heard, because of customization, right? You could figure out the deal you wanted. You could avoid the volatility of that kind of day one pop, where the bankers and the supposed long investors are getting to take a lot of upside off of the table immediately, as opposed to the founders and shareholders and the employees. What else? What is the reason that you would support?
I tell you how I see it, and I actually don't. All these are reasons, but I think that to me the bigger thing, and this is a generalization. It may not be true for eToro. It may not be true for Hippo, but the bigger thing is that to me is that forget all the details of the terms and this and that and this. The main thing is that the difference in the time and depth you can go into the business with the prospective buyers. The fact that you can make forward-looking statements, which you cannot make when you go public traditionally. So you just can go much more in depth in terms of explaining your business when you go down that path versus traditional IPO, where you really get 20 minutes with each, like in a group of so you can really only stay at the very superficial level. So what does that mean? That means that the more you want to / need to explain, the more you want to go down the path and the SPAC route, the less than, what's that? Sorry. Now, again, this is a very big, this is generalization. It doesn't mean necessarily, I'm not trying to, point to a company and say they had a lot to explain, but generally speaking, if you have unit economics that may not be working today, but will work in the future because of this or that, if you have a new product line that you're launching, if you have, again, things that it makes sense. Now, the last thing I would say on that is, and again, it's a generalization, is that there is some correlation between needing to explain more and the quality of the company. It doesn't mean that a company that goes through a SPAC is lower quality than a company that goes public directly. It could be the other way around, but very generally speaking, as I said, any company who could go public directly could also SPAC, not the other way around. So there is some correlation. It's not 100%, it's not even maybe 50%, but there is some kind of correlation. So the companies on this forum are all very high quality company. I'm not suggesting that.
I wanted to remark on it for a second. I was actually, this was a reason why we wanted to do a SPAC, to have a longer discussion and build more resilient investors and have a deeper discussion. I was surprised that it wasn't the case. Yes, we gave the 5-year forecast and not have a random analyst come in and give the forecast. But the discussions were not anywhere close to as, it's a 45 minutes meeting. The institutional investors is pitching you for 15 minutes. Oh, we're a long only, blah, 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 blah. Then you have 30 minutes. We recorded the presentation before, so they're going to actually look at it. So we don't need to give all of the spiel. And I'm telling you, it wasn't as deep. Maybe 1 of 10, you have a 15 minutes follow-up. So I thought we would have more time and go more in depth. This was an intent that we wanted to build resilient investors.
Hello, Yoni.
But just one sec. But Assaf, this is a SPAC, but the SPAC investors you did spend time with them, right? With Reid Hoffman.
I agree. With the SPAC investors.
Yeah. So with them, they really took the time to understand the business, and the fact that they have the reputation that they have, also gave the whole thing more credibility. When someone hears from Reid Hoffman, listen, this is why we think it's great, and we spend time.
There's another point which I think is usually neglected to think about it. In general, SPACs raise more money than an IPO.
Yeah.
So if you want a bigger check, and it actually has to do with more flow, there's implications of that. You should know that a SPAC, you raise more money than an IPO. A traditional IPO is probably $250, $300 million. An average SPAC with a pipe is probably $500 to $600 million. So it does matter as well. If you as a company want to have more money, then usually a SPAC is slightly easier to do this route.
Okay, that last point is very, very important. You were able to articulate the forecast, the vision, not some analyst who had to interpret what happened in a roadshow. That's a very good point, and especially to Omel's point in the beginning, a young company which has most of its growth and upside ahead of it. He wants to control that narrative rather than having an analyst do that. It makes a lot of sense.
Maybe I want to add to this.
Yeah.
Oh, sorry.
Yeah, I want it for the sake of time. I want to go to Howard, who has a really unique, overarching view of all of this, both as a founder, both as an investor, and both as a SPAC sponsor himself. He has his own SPAC. He spends a lot of time talking about the subject. Some of his podcasts are the most popular listened to podcasts, like the one he did with Chamath on SPACs. Howard, make some sense of all this for us, for the founders listening on the call.
Well, I mean, everybody's been right. That's a beautiful thing about this. Let's talk about what was wrong. IPOs, there was 2 lanes to go public, Goldman Sachs or Morgan Stanley. Direct listings have been around for enough time. If they meant to work, they should have worked. And, Spotify's is a good one. I own the stocks. Slack got bought by Salesforce at the price it did a direct listing. So SPACs have been around. It's an old, elegant feature whose time has come. Every app, if they had a swipe right, when Tinder came along and swipe right was made swipe right unique, right? This is the world that SPACs, this is the moment in time for SPACs. So it's an old idea. It's been cleaned up, over time, like any feature, and its time is now. From my side, from the sponsor side, because I'm on both sides of the table. I mean, kudos to Assaf, obviously kudos to Ronen and Yoni. I'm an investor and I know Betsy. And I'm new to the SPAC business, right? I grew up in Toronto. You get a SPAC with a donut the minute you're born, and you have a fucking capital law. You have your first write-off by the time you're first year, because SPACs were used for extraction. Like, let's get oil out of the ground. Let's go get copper. Canadians needed a way to do, that kind of risk type on investing, and SPACs came about. From a sponsor's point of view today in 2021, hey man, if I go raise a growth fund for $1 billion, I got to build a team that can last for 10 to 15 years, right? We have to get along. We can't do our path, like Oren's a one-man show and we're a three-person show. What a great idea to be able to fire one bullet, to put a team together, call ourselves the Traveling Wilburys, let's say. We're a bunch of old timers that love investing. We don't have to be in business for 10 years. We got a 2-year window. We put the band together exactly what we want. And our job is to produce one great hit. That's so much better than the idea of a fund in general. So all you've really done is unbundled a growth fund, right? We took away the power that SoftBank had when Masa got an Uber and said, let's put 400 million in WeWork with no due diligence. in a way, they dropped the ball. All this money that was going to SoftBank Vision Fund 2 has worked its way into SPACs. And what happens is a great feature for people like myself, right? Like, because we get to assemble the team to go focus on targets within our domain experience, and we don't have the pressure of doing 20 companies. We have to do one. So that's from the side that got me excited to be on the sponsor side. I think Assaf and Ronen and everybody else has covered, ad nauseum, all the reasons why on the other side. So I just wanted to get that point across.
Okay.
And it's a privilege, not a right. Like I keep saying this about all these things. These are privileges. So we have the privilege. We work with Barclays. We have great investors. So all the same things we said. If we screw it up, we don't get a second chance. And that's important too. Like, why do all these people get 100 swings at the plate? So it's a very pure, from a sponsor standpoint, it's great. Like if we screw it up, we're not going to be back at the plate. So we want to do good deals.
So how do you and Oren, you're also on the board of 2 SPACs. So you guys are approaching companies to potentially take them public. When you're pitching yourselves, how are you presenting your advantage over another SPAC? How are you more founder friendly or company friendly than another SPAC? The same thought of like how a VC would be a better partner for them.
Yeah.
Yeah,
So
I don't want to. Oh, sorry, Oren. I don't want to.
go ahead. Go ahead.
Yeah, I don't want to be competitive. Like, again, there's so many talented people. So that kind of competition we don't need. We want to fish. Obviously, the SPAC ocean is deep right now and getting wider. Time will tell how long this feature stays in vogue for this moment in time. But we're not competing. I mean, when people said you're going to start a VC fund in 2006, they said, oh, it's so crowded. Here we are in 2021, and I don't know how many seed funds there are, right? So I don't like that. That's a lazy thing to say there's not enough targets and there's too many SPACs. That's just lazy thinking. So I don't think the competition's the issue. I think the issue is, we need people like ourselves and Oren and everybody else hitting the streets, drumming up, finding these companies and these next, Mark Benioffs and these next Reed Hastings that are out there, Assafs, that want to build great public companies. It was something that was taken away from the public for a very long time. So I don't think it's as competitive as you think. At this moment in time, it's competitive, but it'll change very quickly. Okay, go ahead, Oren.
Yeah, so I took the opposite, obviously the opposite decision, not to sponsor. And by the way, I take it every day because I get requests from friends and other people to and they tell me don't do anything and I'll do everything, just we'll be 50-50 or whatever. But it's a personal reason. It's not the personal reason is that I want to focus on the early stage investing and on Zeev Ventures, and and the reason I got on the boards of these 2 SPACs is personal friends who really so I didn't want to support them in being co-sponsor, but I wanted to support them being on the boards, or I agreed to support them being on the boards. So my person, and by the way, of all the people here around the table, I'm probably the most removed because I have a bunch of companies that are, either decided not to do, or in conversation, in the process of doing, have not announced yet, decided to go publicly traditional way, but I'm one way removed because I get the data from another layer. I'm not like Howard actually doing it. So the specs that I'm on the board, being on the board is a pretty passive position. I'm not pitching it myself. I'm not looking for companies myself. My perception, and I may be wrong because again, I'm less close to the trenches than anyone else on the panel here, I think, is that there is a lot of basically competition. The 2 SPACs that I'm on each chose an angle. And one of them, the founders have very deep expertise in telecom. One of them was the CEO of Vodafone. And anyway, they're extremely, I don't know if there's anyone in the world more connected in the world of telecom. So they're not limiting themselves, but they're really looking at companies that they can really benefit. They can maybe, bring them customers. And when I say customers, these are big customers, like tens of millions of dollars a year customer. And the other one, who you probably all know, it's called Keter. It's my friend Oren who's not raised it yet. He's in the process of raising it. Their angle is Israeli ecosystem, Israeli entrepreneurs. So I think that each of the two chose, and I can tell you that, again, from my experience as a board member in companies that are approached and talking to SPACs, again, some SPACs focused based on, fintech, for example. Assaf was not, the people that Assaf was talking with all had, strong fintech chops. And general reputation, and the competition is based on again, Assaf can talk and others can talk about more than I do, but how confident are you that the pipe will happen? Okay, because when you sign with a SPAC, they can still fail to bring the pipe. So you have to be confident that they can bring the pipe.
For those who don't know what a pipe is, just explain what that is.
Pipe is private investment in a public entity. So basically the SPAC process has two stages. First, you sign up with a sponsor, and who already had raised a SPAC. So they're already public. You sign with them. Let's say the SPAC has $250 million, and you agree on terms with them. But then you go together and you raise money directly to the new additional money into the existing public entity, and that's called the pipe, and that kind of like validates the price that you agreed. And so typically, again, this is just like, let's say the SPAC was 250 million, maybe the pipe will be another 250 million,
Right.
And obviously there's variance there. So that's and these people are going to be on your board. Do you want them on your board? Okay, so it's not that. By the way, it's not that different from how growth funds compete, right?
Right.
And it's, by the way, similar skills as well.
I want to go to a question from the audience. I'm going to paraphrase two. One from Tal Givoli, founder and CEO of MedAdvisor, a health tech company. The other one from Raluca Ragab. She's a top growth investor, to your point, from Vitruvian. Both of them are asking how you guys, as a founder, Ronen, Omer, Assaf, how you guys assess your own internal readiness. Like, what are the bare minimum KPIs to consider a SPAC? How do you know that you have the management bandwidth? In general, are you guys ready to be CEOs of public companies? That's a pretty big cultural change in the way you're going to run your companies, right? How did you guys make that decision in terms of like looking internally and saying, we're ready? Omer, maybe you start because you're the youngest company.
Yeah, sure. So I think that one aspect was that to make sure that the money that we raise in this transaction would be sufficient to bring us to break even and be actually profitable. Okay, so and since we have the BMW program, we know exactly when that is going to start and what are the expected revenues, etc. That gave us the confidence that this is a good way for us to secure our time going forward. Now, I can say that, working with the car makers, you're anyway working in a very clear and transparent way. I mean, we've been audited by the car makers as a supplier. So for us, we are already working in a very similar manner to what you would expect from a public company. So it wasn't really a big change in the way that we manage our books and etc. That's basically it. I think that we know exactly what our plans to the coming years, and we have very high high confidence to our plan. So we feel that it's a good plan.
And management team in place, CFO, everything ready to be a public company.
Yeah, I mean, we built our management team in a very early stage. So we have a very good management team from, I would say, many years from now, working very well together, with bringing a lot of experience. So yes, very, very confident that this team can deliver.
Assaf, you ready for quarterly earnings calls? Whole NASDAQ thing? You might have to buy a suit. Just saying.
Yes, for 5 years I've been promising that I'm going to wear a suit when I'm going to ring the bell. So I don't know. This moment is arriving. There is a full kind of book of company readiness for being public. You talk to the banks, they send you a list, you tick mark everything, you go through it, you start to write your, in this case, S4, and you see that you have all of the components. There is a risk kind of thing, you know, because in this document, which is a 500 pages, it's like 10 pages on the company and 490 pages on risk components on the business. So you go through it really, really fast to see where you stand. We've been running the company in some ways in a quarterly fashion. Do you have a number that you think you can basically quantify in an easy way and deliver on? You want to beat and raise. So we've been running it. You have three plans for the company. You have the management case, you have the board case, you have the street case. We've been running it now for, what is it, 9 months and 3 quarters and seeing what's going on. We brought our investors in the last 2 quarters, you know, people that are public company kind of investors, XV and Dragonir and stuff like that, as if we're pitching a quarterly report and they're attacking us and they're saying, fine, you need to tighten this, you need to tighten that. We've been prepping for that for a while. It didn't like pop it on us and then we're doing this thing. I have a CFO that, you know, this is below his pay grade to even take a company public and manage that. We have a chief accounting officer. We have it's a work in progress for a while. We've been, since our B round, this is what we've been doing, prepping the company. Is it the best time to go public for us? Are we fully ready? You know, I have a partner who said it's like getting pregnant. It's like, it's never the best time. It's always like, caught you in the middle of an off time. It is what it is. I think we're ready. You have several, what is it, from like starting this probably 5-6 months to tighten all kind of things that you want. It's a relatively tried and true path. You can get the list of what you need to have, what you can't, and just be honest with yourself whether you can adhere to these points or not.
Well, then, so. And I saw Yoni. I don't know if he's hiding around the corner there, but I saw him come in for a second. But you guys have this really interesting position of seeing the markets from the side of your own application. So you're like the Robin Hood of the rest of the world. Howard, by the way, invested in both companies, and you saw what happened with Robinhood, kind of the volatility. You are seeing the data of the markets right now going up and down. How, you know, I know you're not going to be actively, you know, running the company as CEO, but you and your brother have taken, how long have you been building this company? 15 years?
14 years.
14 years. You're now going to transition into a public company at a time that, would you say, is good timing in terms of the markets for a Robinhood-like app? And are you ready for that transition? How do you see things changing at the company?
So because we've been running it for 14 years, I would say, you know, we definitely feel ready. And because it is what we do on the day-to-day, looking at capital markets, making capital markets accessible for, you know, retail investors, it was only natural for us to think that, you know, one day we'll be a publicly traded company. So we had the perspective from, you know, inside the sausage factory, so to speak. And you know, I totally you know, resonate what Assaf said. It's like there's the long discussion about when is a good time to get pregnant, right? So, and I think it's always you know, if you've been running the business, if you're confident in the business, then you should definitely go for it. I can quote Spider-Man again, but I think I quoted it already, so no need to reiterate. But you know, there's lots of hard work that goes behind the scenes, but the basic, you know, mechanics, dynamics, nature of the business don't change. And if they do, that might be a bad thing. So sure, there's more, you know, more administration, more bureaucracy, maybe some more accountants involved, but that's just the nature of the beast.
Is this a window of time that's going to close? Is there a frenzy happening now because companies know that it might shut?
You know, every day I talk to bankers who say, you know, this is just like 1929, just like 1983, just like 2000, and, you know, who the hell knows? But if you'll ask me, you know, over the past decade and some, you've seen companies opt to stay private for longer, and then you get all of these anomalies in the market, like an Airbnb that comes out at $100 billion, or Coupang now in Korea, and that's way too big to stay private. So I think what we are seeing are more robust businesses coming out. So, I can still recall the dot-com era where you had, all of the companies trading at multiples of 400 with absolutely no businesses, companies that were built, 6 months before the IPO. I think it's not the case right now. I think, I can speak on the, eToro behalf that we do see a complete different generational mind shift when it comes to investing in the markets. It's not like my father's generation where if you would want to invest, you would invest in some fixed income, low yield bond of some sort. People want to invest in brands and stuff they know, stuff they care about. And so I think it's a mindset that is going to stay here for a longer period of time. Will markets see a correction? They possibly will. Will we see this all coming to an end? I really don't think so.
Okay, well, we're out of time. So first of all, I want to thank everybody who attended and the panelists who joined us to give their insight. I especially want to reiterate the offer, the kind offer that Ronen made to fellow founders. We have, like I mentioned, there's several unicorn founding CEOs on the call right now listening in. If you have questions, either email Ronen at eToro.com or me, and I'll try to connect you with Assaf or Omer or Oren or Howard.
I added my email to the chat as well. Happy to help.
Thank you so much. That right there is what TechAviv is all about, so I appreciate that. In 10 seconds, each one of you, look at your crystal ball. Tell me, when we do this call a year from now, will there be more or less SPACs? Will it be a good thing or something frowned upon a year from now? Give me your sense of the dynamics 1 year into the future. Howard.
Well, supply's coming, so unless rates shoot up, there'll be more.
Owen?
I would go with less, but I don't really know. Because I just think it's, it goes in cycles. And right now we are very frothy. But then again, maybe we're still going to be even more frothy in a year. I don't know. So, but I'll go with
less. Good. I like it. Well, then.
Yeah.
More or less SPACs in a year from now. This is going to be a disaster, or this is going to be the hero new method of going public for founders?
So I've put this appropriate background just so you can see.
No comment.
But I will say, since this is our first day of announcement, I can only quote disclaimers. I will say this is not an investment advice. Past performance isn't indicative of future results, and maybe some other fine print I forgot. I think, as Howard mentioned, it all has, as I've mentioned before, it has lots of different moving parts with interest rates at all times low, people looking for investment opportunities. I don't think the music is going to stop. And I think SPACs are a great thing as a new type of vehicle to the market. And this new sort of SPAC 2.0, 3.0 is definitely more mature, more robust. And this is not an investment advice.
The power is with you. You are ready, my son. You are ready to be a public company founding CPO. Assaf, more or less?
I think less. I think that the product is not fully baked yet, by the way. This entire SPAC going through the process, it's not tight enough. There's going to be some shakeups. There's going to be some clarification. I think the instrument is there to stay. I just think it was too frothy in some ways. There's going to be a small corrections. At the end of the day, I do think that what matters is the asset and not the vehicle that bring you to the public market. And I think that's where the focus should be. There's going to be abundance of people that's going to say SPACs are good, SPACs are, it's not that. It's people should do their own due diligence on the asset that they're actually investing in, because afterwards you're on your own. You're a public company on your own 2 feet, and that's what matters.
So do you advise then not to invest in a SPAC prior to its acquisition of its asset, the company taking public?
I can take a position on that. I think there's so many variables on that. It's above my pay grade.
I tried. Omer, you have the last word. Is this the next ICO phenomena, or is this legit, here to stay, solid way of going public into the future?
It depends on the performance of the companies that are now going to SPAC. I think there are really good companies that are doing that. And for that, I believe it will be, the same or higher. And I also hope it will be, because I think it's one of the best things that happened to Israel. So I really hope that it will continue.
Awesome. We do as well, and we hope that great companies go public and bad companies do not go public. They wait it out until they're ready. Howard, Ronen, Oren, Assaf, Omer, thank you very much to everybody who joined. Thank you. Sorry we ran over time. Bye, everyone.
If you win a SPAC game, you know what I'm talking about. We sick of IPOs day one locking us out. My man Randy first told me DraftKings would go public. It's merging with a SPAC and the market gon' love it.